Hello everyone and welcome to another feature video with Nidal Rasheed. Today we're going to be talking and discussing a dual key opportunity in Brisbane. Now for those of you who know what a dual key or a dual income or a dual occupancy product is, it's basically two houses under one roof. So it's still a normal house and land package, but there's two houses under the one roof which increases the rental income, which then turns a normal house into a passive or positive cash flow property. Now, in this example, we're going to be showing you lot 35 Kenny Street in Morayfield. Now, this property here was sold to one of our clients, but I wanted to use this as an example. We obviously have other properties that are similar like this that we can source, but that would be done obviously upon request, and we can put together packages similar to this. Now, in this example, I'm going to show you a 3+2 dual occupancy. What that means is that there's a 3-bedroom, 2-bathroom, single garage and single living area on one side, and there's a 2-bedroom, 1-bathroom, 1 garage and 1 living area on the other side. Now, this particular property is built on 412 square meters of land, and now it is a corner block that we've sourced, so I'll show you the plan so you get to see what we're talking about. It's actually lot 35, which is this section here, and because it's a corner lot, we can actually turn this into a dual entrance. So you got one entrance from the front and one entrance from the side, so from two different street frontages. The land price is $208,000, the build price is $276,000, which gives us a total price of $484,610. Now, in terms of the floor plan, as you can see, there's two units. Unit number 1 is on the right, unit number 2 is on the left. Unit number 1 has got the 3 bedrooms and 2 bathrooms. So you got bedrooms 3, 2 and 1. Bedrooms 2 and 3 share a bathroom. Bedroom 1 has its own ensuite and built-in robe. You've got the garage which leads into the house, and you've got the kitchen, dining and family as an open plan, and you've got an alfresco under the main roof as well. Now, unit 2 is got a 2-bedroom and 1 bathroom. So bedroom 1 is to the side, bedroom 2 is the other side. You got a shared bathroom, and you got an open plan for the kitchen, meals and family, and an alfresco under the main roof, as well as the garage, which is facing the main street frontage. So from the front of the street, it looks like a normal house. However, you got one entrance from the front, one entrance from the side. Now, you might be thinking, where's Morayfield? Well, Morayfield is a suburb that's approximately halfway between Brisbane and the Sunshine Coast. So there's Brisbane here, there's Sunshine Coast up there, and Morayfield is slightly inwards from the Beachmere, which is the main beach there. And the particular development that we're working in right now is on Kenny, or the actual property itself is on Kenny Street, which is right there. This is the lot that we've secured for our clients, and the good thing about this location is it's actually within close proximity to the shopping precinct for Morayfield. So you've got the Morayfield Woolworths, you got the Spotlights, you got Fantastic Furniture, the Good Guys, Amart, etc. It's also got the Morayfield Station, you got the sports club, you're within walking distance to a high school, you've got the you got the transport and all the existing amenities that tenants look for in an area. So from that side of it, it ticks all the boxes. When we've done our research, we've actually seen that the pricing in Morayfield has been consistently on the rise. In fact, the median house price for a normal house is between $450,000 to $500,000, and the rental yields can be anywhere between 4 to 5.4%. This being a dual income property obviously has a higher yield, and I'll go through those numbers in a little bit more detail. But when we look at an area, we're generally trying to find out, is there more demand than there is supply? And in this case, we know that there is going to be a huge population growth happening in the Moreton Bay region. In fact, it's set to increase by over 40%. What that means is every year from now to the year 2036, there's 1,400 new residents moving into the area. Now, we know that there's only 600 homes getting sold in a 12-month period. So what that tells us is there's more people moving in than there are houses getting sold. We also know that the majority of the people moving in are usually families, they're blue-collar workers, and they're renters as well. So that gives us some confidence as investors to input money into an area like Morayfield. Now, mind you, when we're investing in a dual income property, the main aim is really for cash flow. So we're not really banking on a lot of capital growth. However, if we do get the capital growth, then happy days, because then we can obviously get in the best of both worlds. So when we look at employment, because that's obviously a main driver for us, the forecasted number of employment or number of jobs in the Morayfield precinct is about 16,000. Currently sitting at 9,000. That means there's 6,000 new jobs coming in to Morayfield alone. When you compare that to Moreton Bay currently has 122,000 jobs, expected to increase to 175,000 jobs. That means there's 52,000 new jobs coming into the area. So again, that gives us confidence that people who are moving in are moving because of work and because of employment opportunities. And as we know, money is what makes the world go round. Now, in terms of infrastructure spend, there is upgrades to the Bruce Highway at the moment. There's a new rail link that's happening in Moreton Bay, and they're developing a new sports and events centre in Morayfield, as well as a PDA, which is a priority development area for Morayfield as well. So as you know, if you've seen any of our other videos, we tend to focus on four main fundamentals when choosing an area. Number one is population growth, so that we've got the tick. Number two is employment and jobs, we got the tick. Number three is the tenants and the demographic type, and we've got the tick. And then lastly, we look at the infrastructure and the amenities, and that's definitely got the tick. So as you can tell, this does satisfy the requirements for an area when we're looking at it. But like I mentioned before, this opportunity or this particular strategy might not be suitable for everyone. So for example, if you're looking for a development or a renovation or something where you can manufacture equity out of your property or out of this property, then maybe this might not be the best strategy for you. However, if you're looking for a passive style of investment where you're buying a property in a reasonable area that's going to give you good capital growth, it's going to give you a good cash flow, and it's going to give you some tax benefits along the way, then this is probably an ideal situation to be involved in. So if I look into the financials, and this is the main part that we use to assess an investment opportunity. As always, I go through the capital expenses, income and expenses, and then tax and market factors. Now in this example, we know that this property is going to cost $484,610, so that would be the purchase price. In terms of due diligence costs, we're allowing $350 for a building inspection. In terms of our settlement costs, I'm going to work on a 10% deposit, which is about 48 grand. Stamp duty is calculated only on the land portion. So in Queensland, it's actually cheaper than SA, and that comes to 6,200. Our legal fees in Queensland are going to be more than SA, so you're looking at about 13 to 1,500, and that would basically make up your settlement costs of about $56,000. Your loan costs are going to, I've allowed $400 for a setup fee. That's assuming you're going to go for a package. And I've also allowed $7,000 for LMI, which is just an estimate, and that's assuming that you're only putting a 10% deposit. If you put a 20% deposit, then you don't pay LMI. However, if you do pay LMI, it is tax deductible over the first 5 years. In terms of improvement, there is no improvement that's needed because it's a brand new property, so we're not doing any renovations or any extensions or anything like that. Our selling costs, if we decide to sell down the track, we've allowed 2.2% for an agent's commission and 3 grand for advertising costs. So that would make up all of our capital expenses. Now, when we look at the annual income and expenses, so this is the ongoing money in, money out. First thing to look at is obviously the rental. And with the rental appraisal, what we have been advised is that the 3-bedroom, 2-bathroom, 1 garage is going to rent between $340 and $370 per week, and the 2-bedroom, 1 bathroom, 1 garage is going to rent between $270 and $300 per week. So that gives us an estimate of $610 to $670 per week. So what I've done is I've taken the average of $640 per week, and I've also allowed 2 weeks vacancy. So that translates into a $32,000 rental income per year. Now, when we look at the property expenses, you'll notice that the rates are actually quite high. So Queensland council rates are higher than they are in SA. Now, they do include the water rates and sewerage and everything within those rates. But you also got to understand that the council rates are higher because they're spending more money on infrastructure upgrades, and there's more money being spent from local councils on upgrades and things in the area. That will be a higher cost. Now, building and landlord insurance is going to be approximately $800 a year. Your body corporate is non-existent. There's no repairs or maintenance, no cleaning, no service contracts, no garden and lawn maintenance. A letting fee or reletting fee is going to be 1 week's rent every year, which is $640, and your property management, we work on 8%. So that would make up your ongoing property expenses. Now, in terms of your interest rate or your loan costs, I've done this example as interest only. Because I want to show you the raw figures, I'm going to use interest only. So we'll keep the principal aside. It is a 30-year loan term, and because we've done this with a 10% deposit, that means 90% of the value is going to be $436, and we're working on 4% interest rate. As you know, interest rates are much cheaper than that at the moment. You're looking in the threes, but I'm just being conservative and putting a little bit more than we need. The last section is the tax and market factors. Now, in terms of the tax benefits of buying a brand new property, it mainly comes down to depreciation. So there's two ways you can make a property tax effective. You can either negatively gear yourself, or you buy brand new and get depreciation benefits. When you negatively gear yourself, it means that you're losing money to get a tax benefit, and I'm not really a fan of that. It's not for everyone. However, this example is about positive cash flow. So we're really going to be relying on the depreciation as our main way of getting some tax benefits out of this. And what that means is, because the house is brand new, as the tenants start to use it, it depreciates on paper, and that paper depreciation comes off your taxable income and gives you a return. In terms of the market factors, we always work on 3% for CPI, so cost of living goes up every year, and that will reflect in our costings. And the capital growth, in this case, we've allowed 4%. So it's not a blue chip suburb. It's not a high growth suburb, in our opinion. It's not somewhere where it's going to, double in the next 5 to 8 years or anything like that. Hopefully it does. And if we get capital growth, that's going to be a bonus for us, but that's not the aim of this strategy. The aim of this strategy is really to try and get a positive cash flow with some tax benefits, and still investing in a reasonable area as well. So this is definitely not a bad area to invest in, but I'm not painting it out to be that it's a high growth suburb where your money is going to double and go through inflated numbers. The last section here is the taxable income. So what I've done is I've just based this on someone who's earning $85,000 a year. I've just taken an average example. This isn't a high income earner. It's not a low income earner. It's someone, in the middle, and that's sort of reflective of the type of people that we work with. Now, when we look at the 10-year forecast, basically we're saying that this $484,000 property with a 4% growth over a 10-year period is going to be worth $717,000 in 10 years' time. So if it's worth $717 and we've bought it for $485, that's roughly about $230,000 worth of growth that we're achieving out of this property. So that, if you average that out, that's about $23,000 a year that you're going to increase your capital or your net position by. Now, if you think about $23,000 a year that you don't have to work for, that's about $460 odd a week that you're making in capital growth that you don't have to work any extra hours for, you don't have to get out of bed for, you don't have to sell more products for, you don't have to make more profit for. It's purely capital growth, and it's purely passive that's happening in the background while you're sleeping. And we've spoken about making that shift from working harder for money to then making money work harder for you. This is a typical example of how your money will work for you, even when you're not doing a single, thing, or having to work in a single hour more than what you need to. The second part down is the loan and equity part. Now, the loan on this property, as you can see, stays the same the whole way through because the example is set on interest only. But as the value of the property goes up, the LVR, which is the loan to value ratio, comes down. Now, as your loan to value ratio comes down, what that means is you're freeing up more equity in the property to be able to reinvest in future investments. So as an example, let's fast forward to 2024. Right, so 5 years in, The property is now worth 589. You owe 436 still. You're sitting at a 74% LVR, which means you've got $153,000 worth of equity. Now the bank still wants to retain the 10% security because that's what you started your loan off as at a 90% level, which means now we've got $94,000 worth of accessible equity. And that money we can then take to obviously reinvest in another property, or we can just refinance and just bring down the LVR and get the interest rate cheaper. There's lots of options at that point, but the point of the story is that you're obviously getting, your loan stays the same, but the value is going up, which then starts to free up more equity for you. Now, coming down to the next section, which is rental income. As you can see, based on a $640 rent per week over 50 weeks of the year and allowing for some vacancy, it means that we're getting $32,000 rent, which translates to 6.6% gross yield, which then filters down to a 5.2% net yield. Now, in terms of our expenses, assuming that we've got 4% interest rate, that means the interest is going to cost us $17,500 a year. And we've got expenses of $7,000 a year. So that means we've got $24,500 going out and we've got $32,000 coming in. So that means even before we submit a tax return, we've got a positive cash flow of $7,554 or $145 per week. So if you think about it, again, we haven't had to do much more work. We haven't had to work any more hours. We haven't had to sell more products or make more commission or reduce expenses or anything like that. And now all of a sudden we're making an extra $7,500 a year. So if you work that out, over a month, that's $629 a month. I know a lot of people where that covers half of their mortgage payment. I know people that would cover their car payments. That could be your grocery bill. That could be your holiday fund. Whatever you want to use that money for, obviously you have more options because now you're making a positive cash flow year on year. And that figure grows, by the way, because in 10 years' time, as rent goes up and as inflation takes place, we're predicting a $15,000 a year passive income off this property in 10 years' time, which is almost $300 a week. All of a sudden, you've got a bit more options. Now, the best part about this is that even though we've made $7,500 before tax, we've still got depreciation that we haven't claimed yet. Now, in a normal example where you bought an old property and you made $7,500 cash flow on it, you'd have to pay tax on this money, which means you might only end up with $5,000 after the ATO takes their 30%. However, because we've got depreciation of $13,000 in the first year, we can't use that full depreciation amount anymore because we've made a profit. But they deduct the profit out of that depreciation and they add on any other expenses that we've incurred, like lender's mortgage insurance and fees and setup costs, etc. And we end up with a net amount of just under $7,000 worth of deductions. So if we take that $7,000 off the taxable income of $85,000, we're going to come back, or the ATO is going to come back with a $2,500 return. So that $2,500 plus the $7,500 pre-tax means this property is now positive cash flow by $10,000 a year. So again, we've just gone from $7,500 to $10,000 just because of the tax benefits. So let's recap. We're making $10,000 a year positive cash flow. We're making about $23,000 a year in capital growth at a very conservative level, and we're saving ourselves a couple of grand a year in tax, all through one property which we have set up correctly. Again, property is one of my favorite investment vehicles for that reason, because it can do all of these things that other investment vehicles can't. Not to say that I don't invest in other vehicles like shares and business and bonds and Bitcoin and all that kind of stuff, but property is my main one because I know that it's going to give me the cash flow, it's going to give me the capital growth, and it'll give me the tax benefits along the way. Like I said at the start of this video, this might not be the right strategy for every single person, right? But if you are looking for this style of investment where it's going to be a passive investment, where it's a set and a forget and it's managed and it's satisfying those three things, then I highly encourage you guys to reach out let's sit down, put a plan in place, find a property like this for you guys, put that in your portfolio, start making some passive cash flow, start getting some capital growth, start building your portfolio, and start securing your financial future. Because we all know that if we don't do anything about it, our retirement is going to come and we're going to be thinking, shit, we should have done something about it when we had the chance. Unfortunately, financial education isn't something that's taught in schools. People don't learn this stuff, whilst they're going through the traditional education system. So it's up to us to go out there and find the tools and the resources and the strategies to take on board and be able to use this to our advantage. Look, as always, if you ever have any questions or you want particular scenarios run for you guys, or you want the information that I've simply run through this presentation, reach out to me, either flick me an email or give me a call, and I'm more than happy to do it. And I'm more than happy to sort of send you through whatever info that you want. But more importantly, I would highly encourage you guys to even just take that first baby step and start moving in that direction. As always, I hope you got some value out of this. If you're watching this on YouTube, make sure you hit the like button, subscribe, so that way you can stay updated with regular information. If you have any questions, reach out. Otherwise, I'll see you guys on the next video, and have a great day. Chat soon.